Well, we are back from vacation and getting right back into it. So one of the questions I had come up while I was gone and I want to address is a question regarding the VA one-time close custom construction loan, which is where you buy land and build, okay? So this particular question was related to what happens if the appraisal comes in low, if your appraisal doesn't come in high enough for the total acquisition and to support the value that you need to have. So let's kind of go through that. You're buying a piece of land for $100,000. You have found a builder that is going to build you the house of your dreams for $400,000, which includes everything from the trees to the keys. So it includes clearing the land, excavation of the property, connecting utilities, drilling well, putting a septic in, whatever it is that you have to do to get that property 100% ready. All of that is included in that, what we call a total acquisition cost, okay? So total acquisition cost. Then you have your contingency reserve. Our company requires a 2% contingency reserve. 2% of the total cost to build, we have to set aside in an account in the event that you go over budget or the builder misbids and he goes over budget on something or materials come in a little bit higher on something, okay? Now, you're using a fixed cost contract with the builder. So it's not like the builder can just come back and go, sorry, everything has changed. We've gone way over budget, because you're in a contract with them that states that they are building that house for you for this specific cost. So really, truly, the builder should be the one making any concessions or paying for any mistakes that the builder made in his bid portion of the transaction. However, this is if you go to the tile shop, the builder gave you a budget of $20,000 for your tile for the entire house or hard surfaces, and you end up spending $25,000. Well, then there's $5,000 set aside in an account for that. That's called the contingency reserve. If you do not use that money gets credited back towards your principal balance as a principal reduction once the house is 100% complete and the time at the modification of the note. So you don't end up financing it long term, but it's there in an account for you if you need to use it. And it's a requirement. Now, most other construction lenders are requiring a 5% contingency reserve. We only require 2% contingency reserve. So on top of your total acquisition cost, your land, your cost to build, we have to add the contingency reserve, we have to add the construction management fee, and we have to add your interest that you're not going to pay during the construction of the property. Now, there has been a change to the VA guidelines, and VA is now allowing you, if you would like to make your interest payments during construction out of your pocket. You are not required to, but you are allowed to. So we don't have to include the interest carry in the total cost from the builder, but if you do want to have your payments rolled into the total cost so you're not making payments during construction and not having two housing payments, then you're allowed to do that. So those things all have to be rolled on top of your budget. And then the property has to appraise for that amount, because you're financing 100% of what you are purchasing, what you're spending, and the property has to appraise for that prior to construction even starting. So if for some reason the property does not appraise, what are our options? What can we do? Okay, so there's multiple options, multiple solutions with a VA one-time close. Option number one, you go back to the builder and you renegotiate. Now, builders are probably not going to love this, and it's probably going to be tough for them unless they take it out of their budget, their profit, because they're going to obviously have subcontractors that they're getting bids from for all the subcontracting work that needs to be done. And then they have their general contractor's fee. So if for some reason you can get the builder to come down a little bit in price, or maybe you shave off a little bit of square footage, or maybe you lower your hard surfaces budget or your lighting budget, or maybe there's something that you can do to shave off a little bit of money here and there. Sometimes we can waive the contingency reserve as long as you know if there's anything that you have to bring to the closing table during the transaction. If you go over budget, you have to actually bring that out of your pocket or pay that out of pocket. So that's not my favorite solution, but it is an option. You also have the ability to pay your interest payments during construction. So if you have rolled that into the total cost to build and it has, increased your total cost to build and the appraisal is not coming in high enough to support that, then you could remove that from your payment, your total cost to build, and just make your payments during construction for the interest only balance during construction. There's another solution. Another solution is what's called a reconsideration of value. A reconsideration of value is something that we regularly do on regular VA purchases if an appraisal comes in low. So for VA specialty lenders, they will be very familiar with the reconsideration of value process. this is where we go back to the VA with an email from you stating, I want to purchase this property, even though I'm buying it for $500,000, let's say $520,000 now at this point with all your costs rolled in. I'm buying it at $520,000, but the appraisal came in at $500,000. I understand. I want to still proceed with the purchase, even though the appraisal came in at $5,000 and I'm buying it for $520,000. The VA will, and we have often seen them do this, issue what's called a reconsideration of value, where they will allow you to finance the $520,000. Sometimes they counter back. Sometimes they say, okay, we'll allow you to finance $510,000. What they do is they do their own research, and they're going to pull AVM data, which is automated valuation data, and they're going to look and see, what do we think this property is roughly worth? Because the VA wants to make sure that the veteran is not purchasing a property that is, way under appraised for the amount that the veteran is spending. And then the lender, of course, wants to make sure that the VA is going to guarantee the loan with a 25% guarantee. And all of those things have to, work together. So those are the main solutions. Now, the reconsideration of value has to be done by a lender who understands how to request a reconsideration of value. They do a lot of VA transactions and they're familiar. Obviously, our team this is what we do all day, every day. We specialize in VA loans. We lend in all 50 states. And we also happen to specialize in the VA one-time close. So if you are interested in learning more about this, please reach out. You can click the link in my bio, which will take you to my landing page, VALoanBish.com. That's BISH, dang base. A minivan literally driving by with his base. Wow, that's fun. Anyways, so yeah, you can schedule a one-on-one chat with me or with Mike if you would like to talk through the VA one-time close in detail, and we can get you more information and more answers for your questions. So otherwise, like I said, we do lend in all 50 states. We do specialize in VA loans. We're happy to assist you guys in navigating this process. It is complicated. There is more steps required when you're buying land and building using your VA loan, but it is very, very satisfying when you are able to accomplish what you want to accomplish and get your dream home built exactly how you want it for the price that you want it and all that good stuff. So reach out if you need us. Again, DM us or visit the link in my bio.